TGIF, everybody. Hugo, Sinatra, how are you? How's everyone doing? Hope everyone had a decent week with all those bullish numbers that we had for inflation. I wanted to start off here with the TLT proxy for the 30-year and counterintuitive action. So we had two better than expected inflation reports, and the bonds look like they've broken down. Could call 116 kind of a neckline here. And the high was at 121, so it could measure 112 or so. I don't know if we're going to make new lows in bonds. My instincts tell me that I should be looking to buy a break in bonds and that we could have another one of these from wherever low comes in. Everyone with me? See that?
Good early morning, Dale, TGIF.
Hey, how are you? So Kman,
Welcome to the Pleasure Dome.
Yeah, so the yen was a great buy. I went with the dollar instead. It was a decent buy, but you know, that looks pretty good.
Yeah.
You know, like we're going to get a rally back to challenge these highs. What do you think?
Yeah, I mean, as people know, I mean, I bought it down there in the low 132s, playing off this daily Ichimoku cloud, and then got a big help, of course, from the US yields going back up. To me, there's a big, there's an important zone in the 134, 30, 25, 45, call it. I've been managing the stuff around a little bit, and that's where I plan to take the final leg off. If you look at the where is it? Like the highs pre that double.
You want to show your screen?
Yeah, I can. Actually.
Okay, go. Okay, I'm going to stop sharing. Go ahead.
All right.
Hey guys, Jays, Laura, Ivana.
Do you see it?
Wow, very pretty. Yeah.
Very colorful. I like.
Yeah, it's like a rainbow.
Yeah. So here you see those highs here and here and here pre this wash line stuff.
Yeah.
And to me, this 134, 35, 40 is going to be pretty important. So first of all, we've got those highs and lows. It looks it's the neckline of the inverted head and shoulder. It's also this spike low that we had before the last test above, and it could be the shoulder line of another a normal head and shoulder in the making now. And there's some, let's say, trend line protection up around the 134.5 as well. So there's going to be, if possible, my final objective for that position. But I did respect this level as well, so I took a few off just a couple of minutes ago.
Well, you never go broke taking profits. My bias is to take. Yeah, it takes out
what
that.
I was saying on the flow show as well this morning. It's all about, you know, you have to manage your positions. You have to make sure that you make your position as risk-free as possible, just to keep your account happy, and then
you have to get paid.
Your account has the room to take the next opportunity, because there's so many opportunities in the market that you have to make sure to stay in the game before you can even play the game, right?
Yeah, you have to get paid
as well.
Right. So anyway, my bias is it cuts through your downtrend line and then challenges the uptrend line it broke up around 137.50.
Right. Okay.
And then I think that's a big short.
It's very possible, because I think what you were saying about the bond market, if you look just on the top end of my screen here, the US 10s and then the 30s was like pretty spectacular as well.
Yeah.
Because
more spectacular.
Come again?
More spectacular.
Yeah, because yesterday we had this 30-year bond auction, And where I thought it was virtually impossible, they printed the same rate as the prior one. I mean, give and take 1 BP, you know, and then afterwards it continued to pull higher. Same one with this week's 10-year bond auction.
They buy them and hedge them.
Yeah, I think what happened is that the market, the yields market or the bond market realized after the Fed speakers and after seeing the PPI that we're still trading at 10% PPI and 7 or 8 or above percent CPI, and the Fed is not going to change plans. So the bond market repriced once more.
Okay. You also made a nice call on Euro that there was resistance up there.
Yeah.
Blake was short.
Okay, I can share this one.
Okay.
So this one was what I was looking at is this longer term downward channel, which came in at 103.5. Then we had this horizontal support before, which now became resistance at 103.5, pretty clear. But then there was this one which also attracted my my attention. It's a bit of a shorter term, so it's a 4 hours. It doesn't show the big 108 break, but this was this red line, basically the big 108 break.
Yeah.
Then we broken below, had a move down to 103.5. Coincidentally, Jesus, I mean, I'm really dyslexic. And then we went back up, fell short of the 108. Then we went down to below parity, and of this whole move, the 50% retracement is at 103.70. So I added that into this watch area that I have for the euro, and yeah, I was a little short around this trend line. Didn't need much more than putting the stop just above there, which I had my stop at 103.80, never done, and then managed it around a little bit, and actually I pulled them back this morning, because when I look at yield differentials, if you allow me to show me one more screen.
Oh, go ahead.
You see, I mean, you see the short end of the curve, and you look at the dollar and you look at the German rates, which are the ones really taken as a measure point of European rates. They actually move pretty much in tandem. If you look at it here, this little spike, they go up there. Here, this spike, they're going up there as well. It's just they're moving together, and if you look at that's the real differential in the short term. They are just moving together. So I decided to just go flat in the euro dollar, because this is one of my guides to trade for any viability, let's say, of a move, and it doesn't show me too much viability right here and now, to be honest.
Okay.
So that for what is my side, I could share a few more, but that's bringing us back to the flow show, and it's not my show, it's your show, Dale. I give it back to you.
Okay, it's our show.
It's our show.
And it's our show, and
Stel,
Stel, you around, buddy?
I am taking care of some admin stuff, but I'm here. Hello.
Okay.
How are you doing?
How are you? You know what? Let's take a look at your charts today.
Hold on a second, because I am in the middle of.
Oh, okay. You don't have to.
Yeah, give me 2 minutes, because I'm in the middle of talking to our IT guys. Sorry.
Okay. Gold and silver peaked on maybe peaked on that.
right?
Yeah, you know. Here's the picture I have. You know, I guess we could poke to 1820, but to me, it looks like we could get some type of fib retracement here, especially if the yen and the dollar have legs. And I'm not looking for new highs in the dollar, but I think that, you know, we could rally back to 740, 7.5, and just correct this decline. I think that this probably makes it a 5-wave decline with the last drop that we had. So I'd be looking to sell rallies. I'm long now. I think we have a shot to see the 107 handle again.
Yeah.
And I don't think that's going to be that positive for gold. I think there'll be a decent sell-off in silver, maybe 1940 or so, and that these breaks should be bought. I just want to show one thing on that: the S&P may have topped, And remember, I was showing this, wedge line that we've had an overthrow on. And it's real when it comes back and tests it and holds, or you get some action off of it, which we did. And back inside the channel is not going to be constructive for S&Ps back under, looks like 04, 05, depends upon when it does it.
Yeah,
So,
and I think it's also the underside of the that is the underside of that broken wedge indeed. And I had an additional because I sharpened up a little bit on my own S&P because I had a shot at it short yesterday as well. I have this from the 4640 when we really started the decline down to 3600s. 4258 is the 61.8 of that move. So, and that's exactly where we stopped yesterday. So that's an additional point of measure, in my opinion, for the S&P going forward.
Okay.
So just around 4260, really.
Okay, so we almost got there, didn't we? What was the high? 55?
We actually pinned it yesterday.
58. Yeah, look at that.
Yeah, we pinned it yesterday.
Yeah, my bias is that we get a pullback maybe to this moving average here.
Yeah.
And, that'll make bears even more entrenched.
Yeah.
But, I think this could happen. I'm not sure what the catalysts will be. There are many catalysts out there. Maybe it's the bond market. It's just rates again.
It's likely, yeah. Likely to be the bond market, right?
Yeah. Except, it's a long end. So, what, we went from the great steepening to the grand inversion, and now we're starting to steepen again. That's why the long end took the bigger hit yesterday.
Yeah, we are back. I think
ahead.
we went down to, and Stelios was talking about that prior, yeah? We went down to 50 BPs inversion between the twos and the
twos, tens, yeah.
And the tens, yeah. And now we are back at roughly, what are we, 34, 35 BPs, right?
Still inverted, but
still inverted, yeah.
Okay, yeah. So maybe that's going to change here. So yeah, I think that covers a lot. Also, the coppers had a nice run with the gold and the silver. I think you could get some type of retrace in here too. So, but bottom line is everything went up together again, right? Metals, S&Ps, dollar was weakening, and if you get a recovery, a correction in the dollar, you're going to get some risk off. So I think that's what's going to happen probably next week after, for a few weeks, and then we rally again into September. So that's kind of the narrative I'm working with right now, but these will be good breaks to buy. And copper may be down here. In silver, I know, Stel, that, you're looking at still 1950 or so for your order.
I had 1940. I moved it to 1950. It's I think there's a fib there as well.
There's also this moving average on the 4.
Yeah.
1948 is halfway back.
Yeah.
So that may be it. Okay.
It depends on how it gets there as well, but at the moment that's where my order is. Hello, sorry about before.
No problem.
Yeah, so you're talking about metals. Yeah, they're not breaking out yet. So, as I said before, if you want to be long, I wouldn't just go out chasing it here. But obviously, if you've got long from better levels, you get a little bit yeah, exactly. I think at the end of the day, the Fed is going to drive everything. We know that. And we did get 2 inflation measures, which were well below expectations. So the market market wants to preempt the Fed pivot. but the Fed are not telling us anything about the pivot yet. Yes, they did tell us they're going to go on a meeting by meeting basis, but they're still coming out relatively hawkish when they're speaking. So it's a game of chicken once again. Usually what happens is that the Fed kind of comes to where the market is, right? Usually they don't usually surprise in a big way, but the market's getting ahead of itself a little bit. And the other thing is that at the end of the day, on a very, very long-term basis, that everything's going to go higher, right? Equities, metals, everything is simply because of inflation. So when the Fed and the other central banks are tightening and they're removing liquidity, that's a short-term driver for asset prices to go lower. So the market knows that, and it's used to that over the past 20, 30 years. So that's why you're seeing dips getting bought, because people are saying, oh, maybe this was it. And then we go to the next high, and then we dip from there, and then we go to the next high. So it's I think that's one of the main reasons why the market always tries to kind of get FOMO and not miss this dip, because this dip might be it. I'm not convinced that this dip was it, but if the Fed pivots, I think that's then that will probably have been it, and you're gonna see huge amounts of FOMO from pretty much everybody.
I talked to a guy yesterday, thinks the Fed's going to go 75 in September, and then maybe that's it, and then lower maybe a quarter after that.
Well, you know what? The numbers we got now give the Fed reason to not go 75. If we didn't get the CPI and PPI numbers, which missed by quite a bit, I think 75 would have been odds on. But now I'm not so sure. And what are Fed funds doing? Fed fund futures, let's have a look. 66 versus 08. So
and let's not forget we have like a Fed meeting in between.
We have Jackson Hole, yes.
That's right. There's a lot of data coming out between now and then. And good morning, guys. How are you?
But by the way, Fed fund futures pricing now 58, 59 basis points. So that's down from 10 higher than there used to be before. So we're getting close to pricing 50.
Okay.
Just interesting.
All right. So Blake, nice trader intuition on Euro yesterday.
Thanks. We had a lot of comments from like our trading community, the ForexAnalytix community, that were talking about, oh my gosh, the euro is going to squeeze higher. And I'm like it, I've been short now for a couple of days in the euro, and I was like, come on, we're right up against resistance. Think about where we're at. These are pretty important levels. Now, I don't know if the euro is going to break down today, but I would think that anybody who's long the euro is getting probably a little worried. But we do have a really important here. I'll take over the screen. I know you've been trying to get off that screen there for a second. So the thing about the euros, I think we're right at a support zone, and you can see we just tested those lows again right into the 70s, and we made just a slightly lower high, and now we're like coming back down to support. This level is going to be really important today as we go into into Friday, the end of the week, because anybody who's bullish the euro, who bought that breakout, is going to be a little nervous when you have that last piece of inflation data coming out today, which is the University of Michigan consumer sentiment. And the reason why that number is so important is because that's not a super backward looking number. Like when we get the CPI and the PPI numbers, those are July numbers. The University of Michigan consumer sentiment numbers were from this week, and I think the sample size is like 5,000 people. You may not think that's a lot, but that's really taking a survey from like a lot of the just a quick survey of how consumers are feeling right now. And let's not forget that, and there's like in the news last night, I even saw it in the news last night, like a headline, average gas prices dipped below $4. That in the US, and that's good. I mean, because we were just around $5 just like a month ago. So inflation expectations might be coming down a little bit. And remember, this is via the consumer, and the consumer, you know, is kind of like in the driver's seat. And also, remember, inflation is just a mindset, right? It's a mindset globally. You know, and so if it's they talk about the inflation genie, you know, sentiment genie coming out of the bottle, well, you know, it also goes the other way too. So, you know, if people start,
Hey, Blake.
yes, hey, good morning.
TGIF, man. And don't forget that Powell himself told us that to watch the Michigan.
Did he say that?
Yeah, he said it. He said it like in an interview after, or even during the last Fed presentation. He said he would watch the Michigan. So if he watches this, we should as well, regardless whether the consumer knows where inflation is going or not.
Yeah, well, that's a great point. And a couple of people are also chiming in saying, yes, he did. I mean, then we should really be paying attention to that. And that's going to be, you know, as we come into this week, the end of the week, obviously a very important number. One of the things I have to say is, you know, if you bought the euro, you sold the dollar because you were thinking, hey, you know, this inflation data is weak, and I'm selling dollars. You haven't really been paid, right? I mean, here's the CPI, and I'm just, you know, keeping it on the euro. Here's the CPI when it came out. You know, we were around, you know, 230, 240, or 102.30, 102.40. We rallied to 103.60, but we've really come off. There's PPI, same thing, right? So how about if you know, the consumer hasn't really, you know, said, yeah, well, that's a temporary blip. We still feel inflation is going to be, you know, strong for a while. You know, our rents haven't adjusted, you know, mortgage, you know, rates are still high, you know, blah, blah, blah. And, you know, the euro could very easily slip right back below here. So you know, and I'm, you know, I'm going to be watching it really carefully because I am short the euro. This is like my aggressive position that I have on. And if you guys don't know why, I'll explain it to you right now, because I've explained it on a couple of different forums this week. This is a major trend line. It's the 2016 spike low. If you guys don't remember this, there's a 2016 spike low. So you can see how major support. We had a bearish wedge going into this drop right here, and all we're doing is back testing it. And like I've, you know, mentioned many times this week, I don't know if anything's really changed regarding Europe and the Eurozone. You know, and the ECB. I don't really look at what's happened here is like, oh, things have really changed dramatically. And, you know, you look at, you know, what the Fed is going to do. And Dale, didn't you just say you think the Fed's going to, or could, or is going to raise rates, you know, 3/4 points? Somebody said that, one of your guests. Yeah, I mean,
Eddie F and Bine.
Okay, yeah. Why wouldn't the Fed, you know, continue to raise rates at this pace? I mean, you have the S&Ps once again, they've really recovered, you know, quite substantially for the year. Why wouldn't you strike while the iron's or strike while the iron hot?
Yeah, plus the dollar isn't a one-way street anymore.
What's that?
And the dollar's not a one-way street anymore, and a weaker dollar gives them some cover.
There you go. I mean, I like, you know, I know we still have a month and a half before the next meeting or so, but I mean, if I was the Fed, I would just continue to raise rates, you know, while the market's
Blake,
absorbing it. Yeah,
that's very logical what you're saying, but I think it's becoming more obvious that the Fed and the other central banks, they don't want to hike. They prefer not to. Right. So any excuse they can have to slow down, they will take. They've shown this over and over again. What you're saying makes perfect sense. That's what they should be doing. But, you know, if it looks like, I know one data point doesn't make a trend, but if it looks like inflation might be turning, they're going to say, yeah, let's do 50 and see. Why panic and do more 75? They're going to find a way to do it. That's what I'm saying.
They're going to find a way to be dovish and support markets. Yeah.
Unfortunately,
maybe they don't raise rates, but I heard QT is only at a 50% rate, and that in September it'll be full board QT. So you know, that's,
they're
raising
doubling
rates.
their pace. QT in September. So
that's, you know, that tightens monetary conditions without
Mhm.
rates going up.
right.
Yep.
All right.
So-
You know, I want to point out really quick as far as the equity markets go. You got the S&P that's holding a breakout point. It's 4,200. This is a big deal. I mean, you know, if we go into the weekend with the S&P broken out, that's a pretty big deal. If we drop back below like 4,200, I would be a little nervous being on the long side. I just did an interview with Helene Meisler, and Dale, you've interviewed Helene, right?
Yeah.
She's wonderful. I mean, you know, I've known her. I've actually known her via Twitter as long as I think I've known you, Dale, or pretty damn close. Like within like maybe a year of. Oh no, we've known each other since like 10 years ago on Twitter. I've known her for maybe like 7 or 8, but we've talked a lot over the years, and I know I've talked to her husband Ken, and who's Ken Morrison on the markets, and she really like focuses a lot on sentiment. And if you guys can watch that interview, it's right here. I think it was just published on.
Yeah, I'll put the link to it.
Yeah, there she is right there. This is fresh from this morning. You guys should Stella just can put that link in Trader Summit. She talks about sentiment and where we're at in the sentiment cycle. And this is where people start to get anxiety after seeing a big rally. I'm not going to give away the whole thing, but she does feel that the markets are going to come off like in August, at some point, mid to late August. And, and that could suggest, and I'm with her too, that up here, really we start facing some pretty key resistance, because you got the 618 retracement, you got the 200-day moving average, you got channel resistance, a lot of resistance up here. But between today and like, let's just call it like next week, we have to look at other markets. Like you got the NASDAQ. I know we had a bit of a, that's a gravestone doji, it's a long upper shadow doji, but still you could name that a gravestone doji. A lot of people would, but you can also see it's a false breakout in the NASDAQ. So you got to be a little careful with these markets as we go into Friday. So there's the NASDAQ. Here's the Dow, right up against resistance, false breakout. Now I know today we're probing it, but it's still very early today, right? You can see that false breakout there from right here. That's the Dow. I just showed you the NASDAQ, and here's the Russell 2000. And this is a big chart because I can't tell you how many false breakouts that we've seen. Well, I guess I can tell you it's been 2. This could possibly be a third. We just hit the 200-day moving average yesterday in the IWM or the Russell 2000. What happens if markets actually start to roll over today? Let's say that inflation expectation number comes in, relatively hot, or it doesn't come down like the other inflation data has this week, like the CPI and the PPI. So just keep an eye on the markets. I'm not sold that risk is going to continue higher from here. That's the one thing I want. I think we're at a very, very tricky level in the markets, and you have to be careful. It's Friday and it's summer. So liquidity is kind of poor. But there is one last thing I want to point out. Do we have any data coming up? Oh, I don't think we have any data coming up going into
export and import price index in the US.
Oh, we do. Okay, cool. Thank you very much, Stel. So we'll monitor that as it comes out. And by the way, Dale, do you have an interview today, or is it just us?
Yes,
you do.
Yes, I
okay.
do.
All right. So one last thing I want. Kman, we were just sitting in the chat room a little bit earlier, and he was talking about the Rand, about this being a carry trade. Hey, Kman, I know we got less than just a minute here.
Yeah, but
go ahead.
I don't think it's that important. Okay, it's part of CPI probably, so keep an eye on it. Yeah, I mean, it seems to be flagging, but what I was rather saying is that, yeah, I think it's broken down, this dollar rand, but what we were especially talking about, I think, was that I think a lot of carry trades are being done, and the emerging market is really benefiting from it. If you look at the MEX, the rand, let's call those the 2 main ones. they are really strengthening against everything. So it might not move
look at the
that
Euro
much
max
versus dollar, but versus in the process, it's pretty big, right? Euro max is.
We're probing some pretty big support right now. I mean,
yeah, you have that one, but to me, the main one is broken already. So I still think, as I was telling people, that next stop should be somewhere around 20.
yeah, I
Which
mean, it
COVID,
does feel that way.
COVID level we started from.
So if stocks continue to rally, watch the emerging market currencies. They could continue to strengthen. Stella said, sure, that data just.
By the
came
way,
out.
yeah, both import and export price index lower than expected. So that shows price pressures abating a little bit.
Oh, look at that! Look at just that. That's just another thing to fuel risk, and we haven't seen much response. But you know, we've seen the stock market just peaked up just a little bit, but no real response in the dollar. Hey, one last thing, Dale, you were talking about the dollar index, and I'm going to leave this with you because I know you got your interview right now. You were talking about the dollar index. This is a big channel we've followed, had been following for quite some time. We broke it this week, right? So we broke through channel support. All we're doing is back testing the underside of that broken channel. So just, you know, this trend line is pretty significant. You know, you have multiple data points where you've hit, and it's hit squarely. So it's not like
nice look.
You know,
I booked half and have stops at BE now.
Oh,
So,
on your long
from
dollars
yesterday, and I was early. You know, Dixie broke another 25 pips from when I bought it before the number. So, but it held the previous low. That's all it had to do. But now that I see your channel, yeah, I could see how it could fail from there too. I just think that there might be more left in it than
I'm with you. You know, I'm short the euro, so I still think that the dollar. I think people are underestimating the dollar right now. I think, you know, that we can see a recovery.
That's about the area, I think, you know, maximum.
And so I'm with you here, but just be careful if you're long dollars like I am, and apparently Dale is too. Just be careful because we are, you know, challenging the underside of this channel. But I like the fact that, and I'm going to just pull this down here. I like the fact that we had this little false breakdown this week. So that's, see that green line? This is the breakout point. Previous breakout,
and it's the lowest I've seen on the DSI for the dollar in a long time. I think it's 50-55 in there.
There you go. Well, guys and gals, I want to thank you for all of your support this week. Make sure you visit our webinar sponsor, which is the Trader Funding Program. You know, learn how to trade our money, and, you know, not risk your own money. And you know, we had 2 people this week, one yesterday. His name's David. He qualified for a $500,000 account. So he just qualified for a big account. That was yesterday. So like I said, congratulations, David, if you're listening in. I'm not gonna use his last name, but learn how to you know, access larger trading accounts through the Trader Funding Program. It's an exciting program we put forth a few months ago. So, and
David beat Goliath.
David beat Goliath. There you go.
With the market being Goliath. So David did it with a rock. You guys could do it too.
Right. All right. Well, Dale, thank you very much. Kman, welcome back. It's so nice to have you back. And I know the guys for the Flow Show really enjoy having you back too. And Ryan's going to be back next week. Stelios is going to go sail the Open GNC, and aren't you going to be? You're going to be gone next week, right?
He's already left.
He's already gone. He's like, I am out. I am out. And I think Stelios is out next week. I believe he will be, and I'm not joking, sailing.
All right, I'll cover the medals. We'll be okay.
So, but we'll have Steve, Ryan, and Kman back on the Flow Show on Monday. So thanks, everybody. Have a great weekend.
Thank you, team, for laying it all out on the court again for the community. And Zach Manis, thank you for your patience. It's great to meet you. welcome to F.A.C.E. Waiting for you to unmute, Zach.
Yep, just unmuted. Can you hear me okay, Dale?
Yeah, got loud and clear, Zach. Great to meet you.
Nice to meet you. I've enjoyed following you on Twitter for a while, and I'm glad we made some introductions and happy to be here.
Yeah, and I have interviewed Garrett, one of your associates in the past, so I didn't know that that was where you came from, but I'm glad I reached out. Are you going to be sharing the screen to show some of your work and what you're thinking?
Yeah, at some point I'm happy to do that. Have a few charts that we can go over, but didn't know where you wanted to jump off.
Okay. Well, you've used Zoom before, right?
Yeah.
Okay,
yeah.
So you could always just put them up, and we'll start. I read a little bit about you. I do that so that I'm a little bit prepped for talking to guests. And what I didn't get, I knew where you started with Avi. And I was wondering, what were you doing prior to becoming an Elliotician and getting involved in the financial markets? What was the broken road that led you into this game?
So I know you're a very religious man, and I am too. I'm an Orthodox Jew, and we have a concept that we call hashgacha pratis. That basically, we know that like in the Adjustment Bureau, that the Creator of all things has a divine plan. And we don't always see what's going on in the divine plan, but there are things that we can see that happen in our lives that are put there for a reason that kind of steer us on a path. So I came out to Maryland. Exactly. I started off teaching Sunday school in Hebrew school when I first came to University of Maryland from Oklahoma. And that's actually where I met Avi Gilbert. We were co-teachers. He was working as an attorney at the time. And we had a class of some very, very rough seventh graders. It was after school, Hebrew school. They didn't really want to be there. And so, we just became friends. And then, at one point, my wife and I were getting married and we didn't know what community we wanted to live in. And he recommended that we move to the community that we lived in outside of DC. And I was working, in addition to teaching Sunday school and Hebrew school, I was also working as a mortgage broker. Okay. So that was kind of my first entry into the financial markets. And that was, around 2001, 2002, that I started that. Around 2006, started to get a little bit rocky before things like really got messy. And I started to look and pivot to doing something else. I also was not as big into the subprime. I did a lot more of the alt A kind of lending. So hopefully I wasn't contributing to one of the bigger problems. I do know some of the people who are like the two guys in The Big Short. Right, exactly. So I started working with a friend's father at MetLife doing retirement planning and insurance. And so that was, and at that time, Avi Gilbert said, "Hey, you got to read this book about Elliott Wave." And I said, no, Prechter's book. I said, no, I got this, Avi. MetLife has this 10-question asset allocation questionnaire. It allows us to decide how much of a mix of stocks and bonds the person should have, and everything's going to be fine. The market's always up over, a 30-year period when people want to retire. So, we got this. He's like, no, Zach. Like, that was written by attorneys who want plausible deniability if anything goes completely awry.
Right.
Exactly. So, but I pushed it off and I didn't really read the book for a while. And then I was just starting to get my Series 7 and start studying for CFP stuff in 2008. And things were kind of a little bit more volatile than what all of the normal models for long-term gains in the market, seem to show. So I decided to give Avi's book a try. And it was, it just clicked. Like the context of, seeing the market in terms of patterns of an ebb and flow of sentiment just really made a lot of sense, and it resonated. And I started charting and doing that on the side with Avi when right at the early days when he started his website, and started enjoying seeing those counts develop. And at the time I was still very much in following other people's analysis, not just Avi's, and trying to mimic my own and not really trying to create my own charts from scratch. And there were some biases there from following some other Elliott wave groups. But once I started to really look at what I was seeing in a bigger context from my own starting point, things really clicked well. And that's when I joined Avi's site in earnest, and we launched our service Stockwaves, which is focuses on hundreds of individual stocks in different sectors.
Wow, nice journey, and how fortuitous to meet Avi.
Exactly.
Kind of a turning point. I have a Hebrew school story I could tell you. You want to hear it?
Please.
So so you notice that I'm a convert. So anyway, Jewish as well, went to Hebrew school, and like you said, most of the kids in junior high, they don't want to be in Hebrew school. And I learned my Haftorah on a record. I had to keep picking up the needle and scratching it. But anyway, it was a Saturday, and a friend of mine and I decided to ditch Hebrew school, and our favorite hangout was the bowling alley. We liked pinball machines and so forth. So do you think we were conspicuous at the bowling alley in our suits at 8:30 in the morning on Saturday? And then on top of it, my buddy is trying to get dimes out of the ball washing machine. So our parents ended up being called, and that's my funny Hebrew school story. Two
awesome.
Young kids at a bowling alley at 8:30 in the morning, dressed up in their suit and tie. So we're looking at S&Ps here, and I would say that you have a contrarian view here. I know there are some wave guys that have been talking about it. So actually, I want to ask you about this because I forgot who it was. They've been talking about if this is a bear market, it'd be the shortest one. All kinds of reasons why this can't be the end of the bear market that you have labeled as a 4. So,
right.
I think that, if we get this pullback, I was saying maybe to 3,800, they'll become even more entrenched and fight it all the way up. Interesting major topping zone that you have too. So you want to explain the why, and I see you have all the emotions underneath as well. And looks like we will have exuberance again one day.
So I started to really look at Elliott wave as the framework that kind of explains and gives labels for the way to talk about all of the other technical analysis and measures of sentiment and swings in emotions in terms of the market, as well as incorporating cycles, because Elliott wave is fractal in nature and works by different degrees. So I was really enjoying the first part of your show when you're talking with Blake and with Stylanos. And seeing some of the same, shapes and things that you guys were drawing in more rough sketches and with regular trend lines and fib retracements that you're looking for. And we're doing the same, but adding a little bit of the labels. While I know some people get really confused and it's just this alphabet soup of numbers and letters, I think it gives you that framework, and so you can explain when you have this this inverse or this head and shoulders pattern. You can say, well, that's the smaller degree 3, 4, and 5 of a bigger top, and then the AB structure of the start of the correction. And so that's your typical head and shoulders, and it gives you that Elliott wave context. And then I think the other thing that it really helps with is one thinking in terms of patterns at different degrees. And so you have the same structures that manifest inside the larger degrees. So, this is a view that I've been keeping up on my Twitter page as my pinned tweet. In following this progression, I took the normal sentiment cycle of, of denial for the start of a crash and fear, panic, desperation, capitulation. And then I bent that into the shape of kind of an Elliott wave ABC correction. And then I added all of the bullish ones, the despondency, depression, which doesn't sound very bullish, apathy, indifference, reluctance, optimism, excitement, and exuberance, and kind of put them at points where, we're following this subwave path, the progression of the 5 waves inside that larger degree swing. At kind of those points of where those peaks of that kind of emotion could be felt. I think one of the things that's throwing a lot of people off is that what we're counting as the wave 2 consolidation in the moves off of 2020 was so quick and rapid, and that this as a consolidation as wave 4 is so much larger in magnitude that it seems disproportionate compared to the wave 2. But we know that in Elliott wave, we have guideline for alteration. Exactly. So, when you look at this is deep in as far as fibs, but this was incredibly, incredibly shallow. So technically it's still valid. And, Garrett and I, in looking at so many different individual stocks in the sectors, sector ETFs, and drilling down into those, see so much evidence that we really haven't hit the peaks and have not completed a clean structure in terms of this major top. And the exuberance that I expect to see, things were certainly pretty frothy in November to January of last year, but
real frothy.
When we look out, in terms of our looking at different degrees for Elliott wave, and my chart doesn't fill in all of the data prior to like 1950 something, but basically Garrett just did a recent presentation on this, where he talked a lot more about the big macro degree. But what I'm counting is the grand super cycle wave structure starts back in 1857. At the Civil War. Yeah. And so that wave 2 bottomed was the end of the Great Depression. That 1929 crash was that grand super cycle wave 2. So we're still filling out 100 years of almost of upside in that grand super cycle wave 3. So when we're talking about exuberance, it's not just exuberance in the 5th wave off of the 2009 lows, and it's not just the exuberance of the 5th wave off the 2020 lows, but we're also dealing with the exuberance of this super cycle 5th wave, from all the way back in 1930s. So, that's like 4 degrees at very large degrees of exuberance. And, we know that a lot of times with as extended as some of the other 5th waves have gotten, like we have the primary degree 5th wave inside the cycle 5, the basically 1990s, all the way up to 2000, was a hugely extended move. And if we're going to get anything similar to that, the 5th wave that we're looking at, from here, just this intermediate degree 5th, could certainly extend well over 18 months, 12 to 18 months, and could even get another, extension beyond that. And if it doesn't break significant support on that next decline.
Okay, so, on your prior chart, it looked like you showed that the high was due on the 5 on the previous chart. It looked like it was May of 23, the previous chart you had up there.
Yeah,
correct?
more or less. I'm pushing. I mean, this is kind of. I have this green cycle wave 1 here. Really, if this is going to be all of the super cycle 5, then the degrees on this move off 2009 should probably be up 1 level to be cycle degrees. So I have, a sneaky suspicion that this might actually just be a huge wave 1 of a vastly more extended super cycle 5 off of 2009. But the consolidation that we would get after whatever top comes over the next 12 to 18 months, or barring more extensions beyond that, it is going to be a pretty significant decline, even if it's not a grand super cycle wave 4 that's going to match magnitude with 1929.
Cool. Okay.
Great
Wow.
Depression.
Okay. So
but the other thing is that
okay. I don't know. Do you want to do an interview, or
go
you
ahead.
want or a lecture?
No. Interview.
Okay.
Please.
All right. So I'd like to ask you, I know some Ellioticians that think that, and they're good and they're right and wrong like everyone else, right, Zach? I mean, if you have
Absolutely.
a 60-70% hit rate, you're pretty good. They're looking at, where you have, they're actually looking at this zone in the next few months as being an X wave that we're having currently, which leads to a lower low under 3650. Is that an alternate count or not even in your playbook?
I went ahead and gave that a little bit of credence by putting this yellow alt 5, but I have it in my faded mustard where, this drop, this was under ideal support for a 4th wave.
Okay.
And it can count, the NASDAQ can count better. And certainly the Russell can count better as having topped in that move. And there are some of the sectors that Garrett and I are more concerned about. But really a lot of things just do not look like they are complete off of 2020. And a lot of them don't look like they're complete off of 2009. So we're giving things the benefit of the doubt. That said, we do want to see, everything is based on.
I see all your alternate counts.
Is fractal, right?
Yeah. Okay.
Is based on, is fractal in nature, and so we're looking for confirmation at those multiple degrees. And so off of the low, I'm going to try and get this. I like this. This is a put call ratio that I started to use. That is based on dollar value instead of actual numbers of puts and calls.
Okay.
So it kind of smooths things out a little bit. But we're looking for that fractal structure, and so we know that this 5th wave that we want to see to complete that bigger move at the primary degree should be 5 waves. And then we know that inside wave 1, we should have 5 waves up. So far, we only have 3 waves, and 3 waves doesn't give you confirmation of the change of a trend. Elliott wave confirmation, you need 5 waves up and 3 waves down.
So you need like a pullback to like 3,900 and then go again.
Yeah, I think 3980 right now would be ideal for this 4th wave, based on the structure that we're tracking at a smaller degree. But just because you need to see 5 waves up and 3 waves down at a larger degree doesn't mean that you can't give structure within that move the benefit of the doubt. And so that's why we keep zooming in to other to other time frames to look for that additional confirmation. I'm trying to see where this is my somehow along the line my scratch pad that I use for my smaller degree wave counts got labeled as the uber bullish tab, and that was probably around July of 2020. And I said, it's possible this entire thing is just a big wave 1 of the bigger 5th, and it turned out that that's
following through pretty nicely. So
Okay.
I would really like to see a consolidation here. You know, I know you and Blake were talking about, you know, some resistances that were just hit and some false breakouts, you know, over some significant trend levels. So, and getting close to that 200-day moving average. So from everything that we see, you know, especially a number of the sectors that we find are really the key drivers, you know, that we think are going to be key drivers in this rally over the next, you know, 12, 18 plus months, really need a little bit of a break.
Could
So
a weaker dollar
want
be
to
a
see that
driver?
break.
Could a weaker dollar be that?
It's certainly possible.
A tailwind.
I defer to Lynn for a lot of the whys in terms of macro,
Okay.
you know, fundamental analysis.
Do you have a count
you know,
on the dollar?
I don't follow it as closely.
Okay, so
I follow the metals pretty closely, and I know
Okay,
those
how
are,
about
you know, sort of
that would be
correlated or inverse.
okay. Why don't we take a look at the metals?
You want to take a look at gold?
Yeah, that'd be great.
I really liked what you and is it Centillos?
Oh, Stelios. Yes.
Or Stylos, right? What
Yeah,
you're talking about as
Stelios.
far as the retracement levels.
Yeah.
Stelios. I'm looking at the same things for gold and silver as well. Gold's still trying to hold on to this potential to get one more little pop higher to get a better 5 waves up inside that fifth. But silver, I don't know why. I use IQ feed for my data service, and why the futures, the continuous charts for a lot of the futures start with a Q. But silver looks great as 5 waves up complete for that first wave 1 off of a pretty major low in July. So, you know, again, looking at that 1930s would be ideal support. That's about your halfway point. 1970 to 19 is going to be our ideal fib zone, that 382. 50% to 618 retrace are you know, our most normal fibs that we look for. But we want to see that that's a clean, you know, ABC structure. This might be the first A wave. I mean, this is a little bit small to be all of that. So I'd probably look for a little bit more of a bounce here as a B wave bounce inside that A wave, and then another bounce to get your full ABC in a reliable retrace. And on that bounce, this B wave.
Okay, you like the
I do a lot.
Okay, silver miners over gold miners.
So I don't, the silver miner ETF chart is not as clean. It doesn't have as good a price history. I do like to track the TXGM. Do you ever look at that?
No, what is it? Oh, okay.
It is a Canadian, somewhat equal weight mining ETF. It's not really equal weight because it's just really hard to form a basket of mining stocks when you have 12 to 18 of them that are, you know, so much larger in market cap than the other 100. So, but it tries to be a little bit more diversified than the GDX, and certainly more than the Huey. So we're seeing this similar structure in a lot of these.
Yeah, so if we go back to the GDX, which is what most people trade, that was a significant low that we had about a week ago, or 2 weeks ago, 3 weeks ago.
It's not as, we don't have a clean structure off the low yet. And it relies on a WXY consolidation, which is not as common as your standard ABC, where you have 5 waves down in the C wave. But we did get pretty close to a 618 retrace. And it's gone on, you know, more than long enough. And I think with the way that the metals look off of that low is very, very positive. But when we zoom into the structure off of the low, you know, if this is the bottom of our B wave here, I don't know why this is not snapped.
So the bullion, especially the silver, has the cleanest count.
Yes, I think so. And in a lot of those silver, you know, silver has also been depressed a lot more than gold, and so, you know, it could have that that beach ball effect.
Yeah, the gold silver ratio looks like
we want to see. Absolutely. I track that a lot. I don't know if I can bring it up so easily, but we want to see this C wave. We're looking at this as a much larger diagonal, which kind of fits more of the flow of, a commodities ebb and flow, where you have false, moves that look like they could be trending for a long-term rally, but then you get a deep retrace from that. So, looking at it is a bigger diagonal structure, I think helps, but we're looking for a nice swing that is going to be comparable in magnitude to the initial move that we got off the 2020 lows. And that should fill out as 5 waves up over the next, 24 months or so. But we know, just like in the S&P that we were looking at, inside this wave 1, we want to see 5 waves up, and we know what that basic shape should look like. And the initial move off the low is not quite a clean 5 waves up, and it's not clean quite to the ideal region that we'd want to expect for a wave 1 off the low. When you look at GDXJ, the junior miners that probably have more silver miners incorporated in them, that looks a little bit better. And I think it's probably the inclusion of more stuff like AG, First Majestic and some of those other guys. And I'm looking, again, looking at that structure that we looked for, and the, using Elliott wave as the framework. This filling out 5 waves up and 3 waves down as our wave 1 and wave 2 start to that bigger C wave would give us really nice inverse head and shoulders symmetry on the larger charts, or maybe it's big enough that some people might call that like a cup and a handle. That's probably your apartment more than mine.
Okay. Great looks. Really nice looks, Zach. I appreciate it. We'll get our timing together of it being give and take on our next interview. But
I have one more stock that I want to. Do you have?
Go ahead.
Do you have another minute?
We have time. Yeah, sure.
I have a stock. Okay, I have one more stock that you'll appreciate. So one of the things that I noticed, and I think is maybe my big contribution to Elliott Wave, is I was very skeptical of IPOs, just because, as a cynical person, sometimes. I mean, I'm a total optimist most of the time, but when it comes to things like IPOs, I was very cynical that if it was that good, you have some companies like the Lego brand, they've never gone public. They're family owned for the last 90 years. If you have something really good, you keep it for yourself. So the entire idea of an IPO means that, you've taken something as far as you're going to take it, and now you want to cash out. So I started to see a theme a number of years ago, and I wrote an article with Avi about why I thought IPOs were bad, and that after an initial upside run, with very few exceptions that don't do this, a lot of them get a very, very large ABC consolidation that retraces either up 50% or sometimes even way more than 50% of not necessarily the IPO price, but wherever they started trading on the exchange. And I picked Frog as an example because this is one we just highlighted in our webinar for our members yesterday, that looks like it has completed this big ABC down and is filling out nicely, as long as it gets a 4th and a 5th wave to get 5 waves up off of the low. But I like Frog a lot because as a religious person, you'll really appreciate this. Frog is a mnemonic for fully rely on God.
Oh, nice. Okay.
So
I like what they do. What they do
can be very bullish on. I have no idea.
Okay. They're relying on God.
There's a lot of
besides relying
there's a lot
on
of
God.
stocks where it's a ticker for, some things I know what they do. And I know, but there's a lot of charts that I look at because Garrett and I are, we have a request queue where people can submit a request for us to do LEO analysis. So there's a lot of things that I know the ticker. I don't even know I have to go into my settings and this is JFrog.
Yeah.
Limited. And add in the name. So there's some things that I don't even know the name of the company, much less they do. There was something we were trading a number of years ago. It was like a funny example that I use. I think it was BLTH. I thought it was a biotech. The way that it moved, it looked like a biotech company.
Yeah.
It's like, under $5. Somebody told me they do scented candles. I'm like, okay. I don't always need to know what the company does to see the sentiment manifest on the chart. There's a lot of things when we put out certain.
Yeah. So a chart is a chart is a chart. The only difference is the title and beta.
Right. If you have enough liquidity, and that you get, and there's enough volume of people trading it, that you get a decent price pattern, then you can do an Elliott wave analysis, and it's something to trade.
Right. All right. Well, thanks for leaving us with frogs. I think it also was a curse in Egypt, right? Before the Exodus.
Exactly.
Huh? So anyway, shalom.
Yes.
Shalom, bro, and you're now my trading warrior brother. You got through an interview with me.
Wonderful.
I appreciate
Thank you,
your
Dale.
time.
I appreciate it.
I appreciate your time and your great work and the team that you're with. And the best way for people to follow up on this, your Twitter handle, of course, is at Zach. Is it Manis or Mains? Your last name?
Manis.
Manis. Okay, like
Manis.
manna from heaven, like manna. Mannes to follow Zach, and he's with Garrett, and he's been with Avi's his good buddy, so you rise to the level of people that you hang around with. So definitely an elite group that you have there, Zach.
Thank you so much.
And appreciate you joining us on a Friday when everyone's fried by the end of the week. So we'll do it again, Zach. All right, everyone.
Excellent.
Have a great weekend. Remember, no matter what the wave count is, don't just count your waves, count your blessings. And have a great weekend. Do your work, and we'll see everyone Monday. Thanks again, Zach Manis, for being with us today on Friday. Shabbat Shalom. Okay, see you guys. See you guys. Shalom. Yes.